Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. There's been a pause in the setting of new market highs for the most part. Ross takes a look at precious metals, the FAANGS, and commodities. Anything to do with batteries or self-driving cars seems to be hot. Noted West Vancouver real estate agent Allan Angell tells us he has never seen such a sudden turnaround in the real estate market. Does he believe deferred mortgages were the right move? Danielle Park, editor of the popular blog Juggling Dynamite, takes a look at what might happen to the markets under a new administration in the U.S. Plus, at the end of the show, we'll have company showcase updates from American Manganese President Larry Reaugh and Golden Arrow Resources Vice President Brian McEwen. We'll talk to Ross Clark right after this.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
Always a pleasure to be with you, Jim.
Ross, across the planet, markets have taken a pause after, at least here in North America, seeing record highs week after week. What's the story there?
Well, and is this the sell the news now that you've got the new administration in the U.S. and everything's going to turn? But time will tell. The fact is that we've had a lot of excesses out there. We've been looking at the run in commodities here since the summer, and a week or so ago we started talking about the fact that we were seeing exhaustion type of signals getting overbought there, and it didn't matter whether it was in crude oil or the agricultural commodities like the soybeans and wheat. We've seen copper here as the really sort of one of the key ones, Dr. Copper, that you want to keep an eye on, and it's had real trouble getting through this 365 to 370 zone, and if it starts to roll down, I would say under 360 and stays under there, that would be a pretty good indication that overall we could be looking for corrections everywhere. And this has been a pretty good week in terms of the equity markets. It's been that orderly uptrend. New all-time highs into Thursday. Couldn't quite hold them on Friday, but we are getting pretty close to some important both price and time targets in terms of pattern development here. The sequential pattern that we look at has two phases to it. The first phase was completed a few weeks ago, and then we get into a countdown, and we look for days that are closing strong above 2 days earlier. And once that count gets out to 13, you can be looking for pretty good tops and reversals. Well, as of Friday, one of those counts is up now to 11 out of 13. The other is at 12 out of 13. So any strength next week will put these into what we classify as a sell mode. So then all you need to see is a price reversal to the downside to get a confirmation. And in terms of upside targets, a measured target on the S&P is at just over 3,900, and on the NASDAQ, on the Qs, it's at 329, and the Qs are sitting around 326-ish. So not far away. So both from a say price target and pattern target, we could be overdue now for the correction. And over on the Russell 2000, which has been the leader of the big cap or indices, that one now has done another week of upside exhaustion. So very unusual to see that. Only 3 or 4 times since 2000. And so that one sets us up here for the break as well.
What's going on with precious metals?
Well, precious metals had a decent bounce this week. The bigger picture here is that they failed to do well during the November-December rally relative to where they were in August. And this is while commodities as a whole were consistently putting on higher highs. So they sold off into a week and a half ago. We got a short-term oversold down at 1,800 on gold. And then I guess that was Monday, Tuesday. We've got a rally back, retraced about 38% on the gold market of the last 3 weeks decline, and on silver retraced about 50%. But that's going to be some pretty hefty resistance. And because the overall picture for the underperformance on these metals versus the other commodities is looking heavy, then I think the likelihood of taking out those November lows is pretty high on the list right now. So, unless we can push through the resistance, let's call it around 1,900 on gold and the $27, $28 level on silver, I would still just have very, very small positions as far as the precious metals are concerned.
Are the FAANGS doing well now?
The FAANG index, and it's an interesting one because it's the 5 FAANG stocks that we're all familiar with, but the index itself contains another 5 high-tech companies within it. And that index has been screaming along famously here, put in another new high this week, but like everything else, getting a little ahead of itself. One of the indices that has been doing very, very well is the autonomous driving ETF. So anything that has to do with green and the environment these days is really on a tear on the upside, particularly stocks in the battery business or the alternative fuels. But the GRG.V, which is the ETF of the autonomous driving stocks or autonomous driving products, and that would be things like Tesla, Apple, Nvidia, Qualcomm. The big cap names. They probably are. The top 10 of those are 30% of the index, but there's another 60 or so or 70 items in that list. So you get names that are much smaller. They're maybe less than 1% of the index, but if they really come to life, they could have an effect as well. But that index, the GRG.V, and one of its competitors, the IDRV, they've been on a real roll, especially since the election. We've gone from 17 at the time of the election up to 28 on the index, which, when you see that on an index, that's a pretty hefty move. But our exhaustion index on the weekly charts is just now approaching an absolute extreme. And these are rare. These are the type of things that we don't see that often. You saw it in silver back in 2011. We saw it in 3D processing back 6 or 7 years ago. You got it in Apple in 2005, just before one of its big corrections. So this group, everybody is just enamored by it right now. But I wouldn't be at all surprised that when things start to roll, that this will be as tough on the late buyers as the Bitcoin has been for the buyers 3 or 4 weeks ago.
Mm-hmm. What's going on with the cryptos?
Nice correction here, and I say that because we had a good exhaustion-style top at the 38 to 40,000 level on Bitcoin itself. Then had an ABC-style correction, so that's an A wave of selling, a bounce, and then a second wave down. And as of this week, we just got under 30,000 and then bounced back. That's a classic style of corrections you would look for. And at this point, it's a 38% retracement. of the big rally since the summer lows, and it will need to hold around here, this 28 to 30,000 level as far as Bitcoin is concerned. If it can manage to hold in here and turn the corner, but I would say the consolidation, I wouldn't be surprised that it lasts a month or so. But if it can put in a consolidation here and build a new accumulation pattern, then we'd say we've still got much, much higher upside targets. But proof is in the pudding here. So for now, it's a buy on this break now. But as always, we say know where your risk parameters are, and I wouldn't get married to anything these days. If things start to give up ground through support, best off to lighten up, get back to cash, and be ready to step in on a break. But for now, cryptos look interesting.
Ross, thank you so much for being on This Week in Money.
Always good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, Allan Mark Angell talks real estate next on This Week in Money.
Always consult your investment professional before making any investment decision.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Allan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Allan Mark Angell. He's one of the top realtors in Canada. He has sold more than 4,000 properties. He's located in West Vancouver, BC, Canada, and online at theangellgroup.com. That's spelled ANGELL group.com. Allan, welcome back to This Week in Money.
Extremely glad to be here.
Allan, how does the second half of 2020 compare to the first half and previous years for real estate on the North Shore and the west side of Vancouver?
Well, I actually do I'm doing all the areas from April June now, even though I really don't sell there. I want to see how they adjust. My charts that I go back, they go back to 1991 and a couple of areas, the west side and West Vancouver, 1984. So any figures I give you are from 37 to 30 years of stats, and it's shocking actually. As I've told you before in other podcasts, I've been a realtor forever, and the worst year since I've been a realtor, so I started in 72. The worst year we'd ever had was 218, and the previous worst had been 454 in West Vancouver, but so at the Lower Mainland, 218 was the worst year we ever had in total sales. 219 was the second worst year. So we got into this, it picked up, I said it'll bottom out in the fall, and it did, but it bottomed out in the fall. It picked up a bit right at the end of the year. Then we came into 220, and we hit the virus. So by the end of August this year, this was going to be, it had improved over the last 2 years, 18 and 19, because they were the worst and second worst. But August looked like we were going to have the third worst year in history. And all of a sudden something happened. The market picked up at a very rapid rate. So what I've basically done, I've taken the whole year, I'll added up the whole year, like West Vancouver of the whole year, it would be sixth worst. Greater Vancouver, sixth worst. So most areas look like they're going to be the sixth worst. But I then went back from July 1st until the end of the year. So I took for the last 37 years, I took all the last 6 months of the year to see where they rated. And I was absolutely shocked. If you take West Van, as I said, the whole year was a sixth worst, but you take the last half, out of 37 years, it was the 14th best. So that was huge improvement from sixth worst overall to 14th best. Greater Vancouver, the sixth worst year, and by the last 6 months, the 11th best. North Vancouver was the best market in the Lower Mainland. Sixth worst year overall, last 6 months, eighth best. And in other areas like in Vancouver East, it went from the fifth worst year to the 17th best. Burnaby, sixth worst to the 15th best. Tri-Cities, fourth to the 12th. So all those every areas except two really increased. Now, it's interesting. The two areas that didn't increase, Vancouver West ended up the third worst year overall, but the last 6 months were the eighth worst. So out of 34 years, it was still the eighth worst year. The other area that didn't increase was the Richmond area. So Richmond ended up the third worst year overall, but the 10th worst for the last 6. So it's interesting. Why did every area in the Lower Mainland increase from anywhere from the 6th worst to about the 10th to 12th best, except for Richmond and Vancouver and Vancouver West? So it's the only explanation I have. That kind of concerns me because we never find things like that. Normally, West Side and West Van are the same. So I can only the only conclusion I can come to there is that the Chinese haven't been buying as much. So because those areas are strongly the Chinese buyers there. So I'm assuming that maybe because of the virus, maybe because the money's harder to get out of China. You know what I mean? And we don't have the foreign buyers. I mean, we really don't have foreign buyers here anymore. There's no sense in buying. If you came to West Vancouver and you come from Dubai or China or somewhere else or France, it doesn't matter. If you're a non-resident of Canada and you want to buy a $5 million house, your taxes are going to be about $1.3 million. So $5 million is going to cost you $6.3. So the foreign buyers are basically gone. So all we have is the people who live here now. So Richmond and the West Side are still the eighth worst in history over 34 years. The other areas are gone from the eighth best to the 14th or 15th. So it's quite shocking how we're turning around as much as that. But I've never seen that in my career. It's very exciting to watch.
Is it time for the BC government to get rid of the foreign buyers tax?
Well, see, the problem with the BC the government and the bank, I do stats like no. I mean, these stats I've done probably 150 hours to do all these stats. No other realtor spends the time, but I love my job. I've been doing it so long. I mean, our market ended May of 16. My stat, I knew May of 16 the market was over. The board doesn't do the stats the same as I do. I just don't like how they do them. They're misleading and everything else. So even on August 17th, so that's a year and 3 or 4 months later, the board was still saying the market was strong. It was already over for over a year. If they had told the government the truth, they might not have put all these taxes in. But the government put all these taxes in. Everybody's market dropped a third. So the BC government here cost you a third of the equity that you have in your home. It dropped so much in 18 and 19 that's probably why it didn't in 20 because the two worst years had happened. Yes, they should probably drop the tax, but I mean that's going to create more foreign buyers. But the market's on the increase now, and as I said, it's surprising because we don't have the vaccine yet. We don't even know if it actually works, so it'll be months. But the market's quite strong. But it would probably be a great thing if they did. Prices would go up more, but then I don't think the government doesn't want them to go up. They'd rather have them drop. The problem is that they still haven't dropped. If you had an $8 million house, it's gone down to 5.5. If you had a $3.5 million, it's gone down to 2.2. Well, most people still can't afford, even with the prices have dropped. Now they're going up again.
What's happening with inventory?
Well, that's the other reason. The other reason that the market's skyrocketing. It's interesting with the inventory because I go back to the 1991. What was the inventory for each month in the areas? Now, it's interesting. You take West Van. This January we had 309 houses on the market to start with. The average January is 338. So we're only 30 behind. So that's it. But North Vancouver, their average is 224 for January. They have 130, so they're 100 behind. So they're very far behind. If you take Vancouver West, their average is 546 January. They've got 399, so but they're 140 some houses behind. Richmond, same thing, 561. They're 100 behind. But the greater the Vancouver area is shocking. Greater Vancouver average listings for January in houses is 4,949. Say 4,950 houses. This January, it's 2,811 houses started at. So it's so far behind. So that's the reason. The interest rates being so low, and it looks like they're going to stay there for a couple of years. Plus the product, you've got a third to almost 50% less product for sale.
Where is the buying coming from?
Well, I go through all my sales, and buyer, I check every sale. I want to know exactly the month it does. I want to know who's buying, or the Caucasian buyer, or Chinese, or Iranian buyers. I like to know what areas are strong for whatever Caucasian, Chinese, or Iranian. I like to do that. But the buyers are really local because there's no foreign buyers. So they're people who live here. They're people who live here, and they were locked up because of the virus. But I'm not even convinced now that masks are a good thing. I hear doctors that there was a doctor out a while ago said he thinks that the mask hurts us. Nobody knows. So I think the first 6 months of the year we were all locked up. We were afraid to go. But my office I closed down for a couple of months. We didn't want to take a chance. But when you see people get going, their savings are gone. Their house is being devaluated so much. They have to get back to work, and they say, well, do I go to work and take a chance, or do I go down the tube and I start over again? So most people decided, I think, heck with it, I'm going to work. I need a new house. I'm going to buy. So, but the buyers are all people who live in the Lower Mainland, moving around for one reason or another, for sure.
Is this sudden boom in real estate prices and sales sustainable?
Well, it looks to me, I'm concerned about Richmond and Vancouver West because that's unusual. That it's almost, sixth worst and still the eighth worst. But I think it is because the product is so low, the interest rates are so low. I think you have no choice. You have to buy now. You have to buy now because it's probably going to get worse. See, and also what might slow it down is that houses that are coming on, they're all coming on at a higher price. I have a little house on the market there, flip ads of mine, and so it's under 2. And they've had 10 or 12 offers on it because they want to move. But problem is the houses that when they started looking 4 or 5 months ago were 1.9 are now up to 2.2. And so it's hard. It's very hard time right now because they're all coming on high. Like they always come on higher at the start of every year. Anyway, if this is a new year fresh to start high, then by March or April, the market is as good as it was, and the prices will adjust a bit. But our product is so low, I think the prices will have to keep going up a bit.
Are mortgage rates having an effect on prices and sales?
Oh yes. If you don't buy now with the interest rates, I mean, I did one of my houses I've got. I locked in for 5 years at 1.76%. I mean, how can you not? How can you not? So, honestly, if you can scrape up the money to buy, then do your best.
Are low mortgage rates allowing real estate buyers to take on debt that could become a problem if rates go up?
Well, it could be because, as I said, you're getting larger mortgages because the rates are under 2%, say. So you're getting larger mortgages for sure. But everybody I talk to thinks the rates are going to stay down for 2 or 3 years. So, hopefully we're going to be safe. It's not like they're going to start going up in 6 months and they're going to go to 2% to 4%. I think we got, 3, 4 years of rates being a big low. So I think that's where the chance.
Is mortgage lending at the bank still on the conservative side?
Well, yes, it is. It'll probably change a bit because you've got to realize prices have just started to rise. The end of last year, and now they just started to go up. So the banks are always slow to adjust. But banks need a person like me who can tell them what the market's actually doing, not the board stats, which which they're behind times as they always are. The guys on the boards are people who work there. They're not realtors who are in the market. So, I think the banks are still going to be tough because it's still uncertain. You got Richmond and Vancouver West who hardly improved compared to all the rest. So that's a bit. Is it the Chinese? Is it not? I really don't know. So that's something you have to be concerned with. Is the rates are prices still going to go up, or is this little 5 months flux of prices going to stop in 3 or 4 months and go back a bit? My feeling is that we're going to have a good year.
We'll have more with Allan Mark Angell right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Allan Mark Angell. Allan, are the lockdowns and the increase in unemployment forcing some people to sell?
Not that I've seen. I haven't seen that at all. I'm surprised, but in our area where I live, West Vancouver, maybe there are. I actually think the lockdown and the bank deferral rates on the mortgage, I believe it all helped, to be honest with you.
What is the listings to sales ratio for the various categories of homes in West Vancouver?
Well, it's interesting. I break them down into under 2, 3, 4, 5, 6, and over 6 and over 10. I mean, it's interesting. If you're in a 2.3%, at $2.3 million houses, 64 on the market, 24 are being sold each month. 3 to 4 is 62, 34 are being sold each month. 4 to 5 million is an expensive house. There's 49 active, 17 are being sold. And but then you get over 5. You get over 5, and it goes down to 2.5 a month. There's 32 in the 5s, 50 in the 6 to 10, and 30 over a million, but sold 1. So if you're under 4, it's great. I did the west side as well, and it's interesting. And the 2 to 3 million, 65 active, we're selling 39 a month. So over half of them are being sold each month. 3 to 4, 62 active, 28 are being sold a month. 4 to 5, 68, we're selling 10. But then again, you get the higher end, and 6 to 10 million, there's 74, and 4 are selling a month, and over 10, they've only sold 1 the whole year.
Some high-end homes in West Vancouver are listed for sale at 1.5 to 2 times their 2021 assessed value. Is this turning out to be a successful strategy for getting higher selling prices?
Well, it's interesting because if you take the BC assessment, how it's actually changed the last 3 years. In 2018, 71% of them sold below assessment. 2019, 82% sold under assessment. 2020, 78 sold above assessment. Now, if you take the top 20 sales in West Van, actually the top 27 sales in West Van last year, only 2 sold below assessments. And it is amazing. Some of them there's a very large spread. 7.8 sold in the 5, 7.8 sold in the 4. So yes, some of these high-end prices they're getting 30-40% above assessment. But it's the only price range it is. It's just really like $7, $8, $9, $10 million. That's the only range it is. So basically, the people buying those are buying the house because they want the house, and having the assessments lower helps your taxes. So, but in the normal range, 2 million of that, no, it's the assessments are very close.
Are West Vancouver waterfront properties selling?
Well, they haven't changed much in my stats go back to 1988, and the average sales of waterfront. I'm not talking Lions Bay or up that way, Howe Sound, from Horseshoe Bay into Ambleside area. The average sale is 18. That's what we sold for years. But in the last 17, 18, 19, 20, we've had, this year was 9, last year 7, the 2 previous years 9. So basically, we're selling half the average.
Are high-end West Vancouver properties selling the high ends?
Well, I'll tell you how that's changed. We sold last year over 6 million. We sold 39 houses over 6. The first 6 months we sold 10 over 6. So in the last 6 months, 29 over 6. If you take over 10, we sold 2 in the first 6 and 5 in the last 6. So yes, on the west side, you had 51 sales over 6. The first 6 months, 17, and the last 6, 37 or 34. And over 10 million, you sold 10 and 3 the first 6 and 7. So yes, the high end market is quite strong. It's not as good as it was in the past. In other years, we saw 216. We would sell 50, 60 houses, and now we're down to over like expensive houses. Now we're down to half in that range. But they've started to sell again, so it's back to average in the last few years.
Are empty homes still an issue on the North Shore and the West Side?
No, I'm not aware. I don't even hear any discussion about it.
Are foreign buyers now on the sell side instead of the buy side?
Well, the foreign buyers are different. That's what I like about our society. As I said, we have the Iranians, the Chinese, the Caucasians. We all have a slightly different view on buying houses. The Chinese love real estate. They buy and they hold on to them. They just don't sell them. They want to hold on, but some of them, if they're buying more, then sometimes they do so. What if a house isn't as good as it ought to be? It looked good at one time, but now it isn't as good. They may try to unload it. So they may try to unload the house now. But the foreign buyers, Chinese especially hold on to the product because they want to own a whole bunch of houses. The Caucasians just move because they want a nice home. They're not, they worry about their family and working. And, we don't make as much money as the others have. So they settle in the house and they tend to stay there for a long time. There's a few who flip houses and invest, but, they haven't been flipping down for 3 or 4 years because there hasn't been a profit there. So it's, the foreign buyers tend to hold their houses more.
What effect have deferred mortgage payments had on inventory?
No, I tell you what, that was actually good because we had a lot of foreclosures last year. And, but all of a sudden, the mortgages all got deferred for 6 months. So people didn't have to make the payments for 6 months. So that basically stopped the foreclosures. And so now, hopefully, that, and the banks aren't being as tough on foreclosures as they were. So that was one of the positive things that came out of the virus, is that if you're about to lose your home, now they would defer your mortgage for 6 months, and you kept it. And maybe, things have improved for you now. The market's starting to pick up. A lot of the businesses are starting to pick up. So I believe that actually helped. It stopped the foreclosures. There's still a few, but not anywhere near as many as there were. And, it gave people time to, regroup because our expenses are down.
Are you seeing foreclosures in West Vancouver?
Nowhere near as many as you were a year ago.
When real estate prices go up, is the increase based on the structure or the land?
Basically, if it's a low at $3 million, another, it's probably the land. But you get to be the high end, it's a lot more the house, because the houses get to be 7,000, 10,000 square feet, so that's what they're buying. If you want that big house, now the structure becomes important.
If people price their property above the market today, are they likely to get a sale?
It depends on how far above, but the market's catching up. I'll give you an example. I had a sale a year ago, so not last December, the year before that, and I priced the people's house at about 4.7 or 8. But they had so much work to do on the house to buy it, they decided to wait. They couldn't move into the house they bought, and so they couldn't sell their house they had until the end of last year. And so all of a sudden, October, November comes, it's time to sell. And I told them to list at 4.9 in December of the year before. I said, no, we're going to try higher this year because the market's changed so much last couple of months. I put it on for 5.9. I sold it in 2 days at 5.6. So they made $700,000 more than they did a year ago.
Are developers bullish on high-end homes?
No, it's still scary. There's a lot of high-end homes for sale, and it's still scary. You think that over 6 million, between 6 and 10, there's 50 listings. Over 10, there's 30 million, and we're selling, through 3 to 4 a month out of 70. So it's not really. You have to stay away from that because it's not safe.
Do you invest in real estate?
Not anymore. I'm too old now. I'm an old guy now. I'm just trying to hold on to stuff I got. It's tough because that's one of the hardest things about the drop in the market. I've been around so long, I've seen a couple of drops. 1981, 2008, and this one here. And, it came back. But now you get to be older, and when your house has dropped a third in value since 2017, and you're 65, 75, you're not going to have time to gain that back. And so now, when you're just older, you just hold on to the stuff you have, and you want to live as long as you can to gain it as much of it as you can. If you're 40s or something, then fine. You don't worry about it because you can still invest because in the long run, it's still going to go up again. And you think of it. The first waterfront I sold was in 1973 for $110,000. And then in 2007, I sold one here for $30 million. I mean, I thought when I sold for $110, I made $7,000 because I listed and sold it. I thought I was rich. And this was the same street. The two of them were on the same street, actually. So who could foresee in 73 that there's going to be $30 million sale a year? You can't imagine that.
If people are planning to sell, should they be listing now?
Without a doubt. I mean, your house will go up, but if you think you have to sell, in the next year or two, you should be listing and selling down. The reason for that, because if you're going down, you don't care. But probably about 70-75% are moving upwards. So if you're changing a lower priced house for a higher priced house, the spread's going to get further apart. So if you're moving from a 2 to a 3, a 3 to 4, whatever, that spread will probably go from 3 to 4. Now it'll probably go to 3 to 4.5. So if you're thinking of moving up, yes, you should be selling and buying now.
The U.S. has seen a dramatic upturn in new housing starts. Can we expect to see the same thing in British Columbia?
Well, I'm not often I think about the U.S. I follow their politics, and I take 4 hours a day on what's going on in the States. And I've always loved the politics. I thought about running for mayor in West Vancouver, but my wife said, "There's no bloody way. You're too outspoken." And so, like, I talked in the town hall once a few years ago, and I talked about the NDP had dropped the prices of the houses a third. I said they ought to be shot. I didn't even realize you said that. It was only a joke, of course. I forgot I even said that. That the next day, the nasty. My wife was the texts and emails were so nasty. My wife was afraid to go out the door. People take things so serious now. And one thing I have learned is that the news, 95% of the news is wrong. And absolutely anything. I spend 4 hours a night on the U.S. election and politics. So I figure I know as much about what's going on in the U.S. than anyone else. And what's happening down there now, I think it's going to be, it's moving so far left that I think the housing market is going to have a tough time. Their economy is going to have a tough time. They got a problem down there. And we somewhat have too. And if it happens there, it'll probably move up here. So I am concerned about certain things that might happen. But right now, I would take advantage of the money you can get out of your house because we're probably safe here for few years at least.
Allan, how can people contact you?
Well, I'm Angell Hasbett is my company. Allan Mark Angell, my partner is Malcolm Hasbett. We're Westbound, so they're easy to find. We've been here a long time, since 1996, when I started the Angell Hasbett firm. But the easiest way is my phone number, 778-888-7474. And please, even if you live, I'm a chatty Cathy. I've always stuttered all my life, but I'm a chatty Cathy. So even if you live out in Burnaby or somewhere else, you just want an update what I think the market is doing. I mean, last year was a really an adventure for me. I sold a house in Coquitlam. I had to go to Vancouver Island. I sold one Courtney, Gabriola, came back to the Sunshine Coast. I took more rides on the ferry last year than I had done in years. I'm all over the place now because I love selling houses. That's what I do. So, but if you wanted to just have a chat, I'm easy to talk to.
Allan, we should bill you as BC's top-selling real estate agent.
Well, as I said, it's not unusual, but I hadn't been in Coquitlam in 20 years, and I can't get over how the traffic is. I remember years ago, my parents lived there. We could drive to West Vancouver no time at all, and boy, I tell you, the traffic even in North Vancouver now is a nightmare. So it has changed, but I like selling out. I love dealing with. I'm not really in sales. I try to put people. The biggest problem that I have, I tell the truth. I had 5 appraisals at the end of last year, in the last 3 or 4 months. I told them all the exact price. I never got any of those 5. They went to Reaugh at a higher price. They've all sold, and I told them 2.3. Realtor listed 2.9. Every one of them that sold exactly what I said it would. But people think, oh well, this realtor is not Allan Angell, he's nowhere near it, but if he can get me 500,000 more, I'll try. But they just go in there, they don't do the research on the market, so they go in there to sign up the house and do that. So that's the toughest part I have. If I tell the people the truth, I may not get the listing, so all I've done is help the other realtor get it, eventually close the price. So if you want the truth, talk to me. And please, but if you want to put your house on higher with me, I'm happy with that too, because a lot of times I get more than I expect because the closing is the key. The closing is the key of the house.
Allan, thank you so much for being on This Week in Money.
Thank you kindly, Jim. You have a good day. Thanks. Bye-bye.
My guest has been Allan Mark Angell, leader of the AngellGroup.com. Angell spelled Angell. Coming up, Danielle Park next on This Week in Money.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMY.VResources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated, her website jugglingdynamite.com. Welcome back to This Week in Money, Danielle.
Thank you, Jim.
Danielle, can you tell us a bit about Venable Park?
So we've been around for about coming up 18 years doing individual risk management for portfolios 1 million and greater all across Canada. We're absolute return, meaning that we don't consider relative performance to an index to be our benchmark. In other words, if we we're always trying to have a positive year and avoid the drawdowns that are inherent in a risk in a buy and hold portfolio. So we're quite a different approach. It's all about capital preservation, positive compounding, avoiding drawdowns. We're not passive allocators. That's basically it.
So you make sure people don't lose money.
That is the focus, yep. And we've been successful so far. So, in the really bad market years, we've continued to have positive returns, and that is really the goal.
Your thoughts on President Biden's inauguration?
Well, I mean, I think that seeing the crazy man leave town has got to be a positive thing. Not because he's a Republican, but because he was absolutely nuts. And it distracted policy from, serious work that needs to be done in terms of coming up with solutions. All this name calling and the lowest common denominator, appealing to the ugliest side of humanity, I think is very destructive. I think it's done a lot of harm, evidenced by many of the things that happened in the latter phases of his tenure. So I think that in Biden we have a return to more business as usual. Now I'm not totally enamored of the business as usual mandate, because I think we have some very pressing issues in the world today that need to have a more proactive policy response, different than what some of the status quo stuff we've been doing. And I do think that Biden is a centrist, which could be good in terms of coming together, bringing people back to a negotiation somewhere in the middle. But on the other hand, to the extent that it just continues status quo policies, I think they're at risk of losing again the slight advantage or the slight majority that they have in the, even in the 2 years from now in the next election. I think that that's a very precarious position. They have to show that they have an interest in helping some of the half of the population that is not doing well and hasn't been doing well for decades. And they have to show that they are distancing themselves from the policies that have continued to widen the wealth gap between the haves and have-nots and caused a lot of social unrest that isn't going to be quelled by just continuing with status quo. So I do think that there's an opportunity here to get back to thoughtful responses, collaborative work, focusing on the things that matter rather than on the things we have in common rather than all the tiny little differences that people want to focus on when they're in a very negative mind frame. So I think, I'm happy to see the crazy guy go, but I'm a little bit concerned about the extent to which serious work will now happen.
Will a Biden presidency be good for the green energy sector?
Well, truthfully, the green energy sector has been doing great even under the Trump administration, right? The reality of that is that there is a huge economic case to be made there, and it is not really about government policy. Now, government policy can be, help, frankly, in the way, for example, whether it continues to fund the bulk of its subsidy dollars towards oil and gas versus sharing it to other types of energy or diverting a fairer share to other types of energy. If they're going to be doing subsidy of any energy, they should be doing it more even-handedly to up-and-coming technologies. So I think that there's some policy change that could be sort of helpful. But on the other hand, as I say, the economic case is so strong for green energy. Fossil fuels is really on the back foot in losing any competitive advantage, even without any kind of tax breaks and that sort of thing. Driving an electric car is a lot more cost effective. That's not even counting the carbon benefits of plugging into a grid that in Canada, for example, is nearly 70% produced by non-fossil fuel emitting energy. So the States has a lot of work to do in making their grid more sustainable, and I think that there's going to be a focus on that now. At least that was the promise in the election, right, that they would focus on that. Now, having said that, the more extreme ideas, that were communicated by what people would consider the far left were definitely not what the Biden administration was mouthing. He was much more talking about more centrist policies. So again, it could be that, he was doing that just to try and not be seen as extreme. But really the extremity that's happening here is in the status quo and the destruction that's going on in both the economy, in the jobs market, in the loss of productivity that's happening. So I think that, again, there's a lot of opportunity here for governments to get behind or support the trends that are already underway. But whether they do or not, I think the economic case for this move towards green energy and electric cars, fossil cell, hydrogen cell cars, that sort of thing, that's going to continue regardless.
Do you think more people will buy electric vehicles during a Biden presidency?
Well, I mean, certainly if they bring in more, tax credits, deductions, that sort of thing, if they increase that, there may be more incentive for individuals to buy new electric cars. That said, there's a lot of used electric cars now available on the market, and each year there gets to be a larger inventory of that. And in most cases, that's a better financial decision for individuals if they're going to buy a vehicle to buy a used one. So usually the tax credits are on the brand new side where people either lease or finance. And frankly, trying to get into the most cost-effective vehicle is a really primary goal for people today who are trying to save and pay down debt and that sort of thing, do things in the most efficient way. So I think you could see that, more incentives rolled out. He certainly talked about that. We'll see. I just don't think it's required. I mean, it'll help, escalate it perhaps, but in terms of the math, it's much more cost effective to try and operate an electric vehicle. So I think once households understand that, you don't really need any other incentives.
What other sectors do you think would benefit from the Biden presidency?
Well, I think the fundamental difference, frankly, overall, is that we have an administration that's coming in that actually believes in science. I think that's a huge help. Especially nowadays when science is so important in our understanding of our impacts on the climate, and in terms of the virus, the pandemics, and let's face it, the COVID pandemic is not the only virus that threatens humanity. There's many of these things moving through the world. I think that, to the extent that people have been able to, deny facts and hide in ignorance, that's all very negative and destructive. We have to really, admit, repent, reform, recover are the steps. So admitting first is that there are these issues threatening humanity, that we do have ideas that we can respond to them. So the next step is reform some of our systems, make things more supportive of our existence on the planet. And then, we can look at recovery out of that. And there is a huge economic stimulus available to us if we can figure out how to cut all the waste and harm that we're inflicting and increase our productivity, which for the last few decades, productivity has been falling and falling and falling because we keep doing the wrong things, right? We keep investing in antiquated technologies and systems that have huge full cost accounting impacts that we're not appropriately accounting for. So there's all sorts of things we can do to be a lot smarter and to embrace science and figure out solutions. And I think that to the extent we have that, at least in the new administration, that's got to be a positive.
What sectors are you looking at buying now?
Well, at this point, we've seen such a huge recovery or rebound since the March 2020 low. That everything is pretty much off the charts crazy again in terms of pricing. So it's very difficult. It's one thing to articulate what sectors you think there should be economic demand for, growing sales and that sort of thing, and then it's another thing to say whether or not that's an investable thesis at this point. So I mean things like there are ETFs and other funds that invest primarily in things like, solar and wind and this sort of thing. But when you look at the charts and the pricing, the valuations of them today, they've all been infected with this really bubbly, frothy market we've seen with all the speculative fever that's been going on. So I think it's best to really just make your list. So at this point, as I say, there's things like the FAN ETF, which is of wind companies, and then there's things like the TAN ETF, which is focused on solar companies. So there's that type of thing that you can, there's semiconductors in index, the SMH, which is a U.S.-based ETF that has semiconductor companies in it. These are the things where I think that enormous growth potential lies. My problem is that they have been priced to insane multiples. So in other words, if you think that they're going to have strong growth over the next 10 years, the pricing presently would need you to wait about 150 years to get any return on investment, which is absolutely crazy. So, you have to really, make your ideas about what are investment sectors. That's one thing. Figure out what allocation limits you want to have in terms of risk exposure to any particular asset class. That's a very important step. And then also waiting for pricing to become investable. And that, I think, we've had this big inflation trade since March, as I say, as the U.S. dollar fell from a peak of 145 against the Canadian dollar in March. Now, somewhere around 127. The U.S. dollar index as a basket of world currencies, but primarily against the euro, has been floating around recently about the $90 range. And if we do see another recovery, so that weakness as the dollar fell was really the wind behind all these other risk trades, whether it's cryptocurrencies or, corporate debt, whether it's equities, emerging markets, developed markets, everything that was really risky went in a straight V up from the lows in March without a retest and as I say, without any rational connection to the real economy or to return prospects from here. So I think that what we could see is that the U.S. dollar, when it gets another strengthening leg, and my kind of overall thesis at this point is there was a lot of questions coming out of, in the spring and summer there was a ton of questions, not only with respect to this pandemic and how long it would take to get that under control, but also with this whole transition of government in the United States and to the extent it would be, messy and drawn out and that sort of thing. Well, we've had a lot of things answered on that front, right? At least we know that we've had the transition of power. We do know that it's a very tight power struggle, but there is a slight majority, there potential for some policies, and there's this pressure, I think, as I said, on all politicians today in Canada as well, to actually come up with any kind of policy that will support the middle class, the working people, the people that are the massive unemployment right now in the country. So there's a lot of, there's been this reflation trade for those that have assets, but in many ways that has been completely non-productive and counterproductive to anyone in the real world, in the real economy. So I think that we should get now more of a, at some point here, first of all, the revelation that the virus is not going to be quickly contained. I think that's part of the sobering process that is now taking place. Not only because it's much more difficult to roll out the vaccines, and there's a lot of complexity around that, but also that even once we get, that there's a large portion of people that are not keen to get the vaccine. They're trying to get this idea of 60% inoculation rate by sometime in the fall. But there's still question even as to we know that there's these high efficacy rates reported on these virus, the shots, flu shots, and the vaccines that have been reported by the companies creating them, but they mean in the actual lab, right? And in terms of the general population, even the seasonal flu vaccine is something like 40 to 60% effective. That's considered a really good result. So if you've got not even 60% of the population getting a vaccine that is maybe 50% effective, and then there's still question about whether you're still contagious in terms of spreading the disease, even if you've had the vaccine, I think the reality is we're going to have distancing measures, the requirement of masks and, less people in crowded congregations and this sort of thing, probably for another year. And indeed, many of the Canadian health officials have actually said that they agree that that's the most likely scenario, not just here, of course, but in other countries. And so again, if you look at all that on balance, you would have to say that we know that it takes typically years to recover lost jobs, not months, no matter what governments do. Really abrupt job losses are very difficult to absorb and to get people retrained. As I say, in many cases, the old sectors have to are in retreat, and we need to see people retrained, and refitted. Maybe, moved over to some of these sectors that are going to be the big growth ones for the next decade. So as that happens, that's a kind of a sloppy, messy process, and it's all necessary and important to set up longer term growth, but it doesn't sort of do quick profits in the near term. There's a lot of upfront investment needed here. It's very capital intensive, but throwing it into, financial markets is not going to do it. We have to get much more into the nuts and bolts of the actual economy and the workforce here. So all of that is much longer term, really vital, but not a quick turnaround. So I think that financial markets have generally just been in a world of their own dreaming. And all we need to see is a next sobering realization that they've overshot the moon here. And, you've got a lot of highly levered individuals, a lot of day traders, people picking stocks, buying them on leverage, call options, all this normal, euphoric stuff that we saw, for example, at the top of the tech wreck bubble. And one thing I like to point out to people is that, they say, well, it's different now because there's computers trading, there's computer trading of stocks and all these derivatives and things. But the reality is that, it's like in 2000 when people would say, well, it's different now because we have the internet, we have computers, this is a whole new ball game. And it absolutely was, right? It definitely changed everything about the way that humans interact around the world and opened up all sorts of new business lines and possibilities. But the reality is that the stock market was way too jubilant in its pricing of those trends and the extent to which they would be profitable. So we saw that even though those themes were correct and durable and continue to this day, stocks still fell by 80% in those high growth sectors. The ones that people thought could do no wrong collapsed by 80% and took 15 years to recover their previous price highs. So it wasn't that semiconductors weren't this miracle technology that revolutionized everything about the internet and the way that we interact. That was all true, but the pricing was ridiculous, right? So I think that is where we are today. There's a lot of really exciting prospects for serious investment in terms of the nuts and bolts and retraining the population and all these positive trends we can support. But in terms of the actual investment thesis for people looking at putting money into publicly traded stocks, I think there's a huge amount of capital risk there, and there's going to be a much better entry point for this once we get another retest. And I think that the March lows that we saw in 2020 are very likely to be retested and indeed may not hold. We could very much see a price retracement that's similar to what we saw after the tech wreck, something in excess of 50%. And at that point, we could get some very attractive entry points for some of these growth sectors.
Under President Trump's tenure, the U.S. stock markets continue to hit new highs, with the Dow hitting 31,000 points. What do you see the Dow doing during a Biden administration?
Well, again, you see, it's really not to do with the president at all. That's kind of misguided thinking. It's really to do with the capital structure cycle. So what you saw when Trump came in, it was already very overvalued, generally speaking. We'd already seen one of the longest economic expansion in history. So he was coming in very late in that cycle. We also had central banks that had never taken their foot off the gas, right? They had continued to inject continuing stimulus throughout. They never sort of pulled back and got rates back up so that they would have some gas in the tank for the next downturn. They really just, kept plowing money in and in and in. And so what his idea was is to cut tax rates, which of course he did significantly for corporate taxes, for example, from 35% down to 28%. So that all seemed very bullish for people that weren't actually paying attention or doing math, or were just looking at how to get a short-term profit, because indeed the companies then plowed that money back into buying back their shares, which was a self-fulfilling prophecy and pushing up prices even further. But they really disconnected and didn't do any service to any kind of investment thesis, because what ended up happening is the deficits ballooned. Of course, this goes back to the point, it doesn't matter whether you have a Republican or a Democratic government today, because the add debt and stir has been the policy for the last 40 years, regardless of the party, regardless of whether they espouse conservative principles or not. They've been just adding debt and goosing asset prices as their go-to. So all that was very short-term. It's the mirage of progress, but when the water disappears again, when you realize that all you've done is create asset bubbles and you've really diverted capital and energy and intellect away from legitimate pursuits that would really make a difference in the long run in terms of improving efficiency and all sorts of real progress that could be made. When you realize that this has all been a sort of wasteful diversion, and now tax rates have to go back up because they've got these massive holes. When you realize that they cut those rates at a time when tax rates had already been falling since the 1940s, and we're now in countries like Canada and America are now well below the OECD country average in terms of tax revenue to GDP. Then you realize that we're now at the beginning of a period when those trends have to reverse, and that's the meat of the matter. Whatever the figurehead would have been, those long-term trends are what they are. The debt levels are what they are. We have 365% debt globally to GDP in the world. That's unprecedented, never seen anything like this before. So, a new president isn't going to matter. More debt was added under the Trump presidency than any other time, and before him under the Obama presidency than any other time. So we really have to get away from these kind of kindergarten-style analysis, which is, it's this president's fault or this prime minister's fault. We're really talking about systemic forces that have been going in one direction for a very long time. And this is where I go back to adults have to look at math and say, these are obviously where we've underfunded, where we have neglected, where we have let things become very fragile because we have not funded things correctly, and this is where we have to now reverse course.
We'll have more with Danielle Park when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Danielle Park. Danielle, is returning Fed Chair Janet Yellen likely to expand or contract the money supply?
Well, as I say, she's her big thing has been from the Fed, years at the Fed and then years heading the Fed. She's an add debt and stir person, and that's been her one idea to try and stimulate demand, stimulate employment supposedly, but all they've actually done is stimulate asset prices, and the higher asset prices go, the more waste and non-productive use of capital, the further and further we've slipped behind. So I think that she will continue to have those inflationary ideas in terms of assets, but she is really not very likely to have a major impact on anything in terms of the real economy, more than any other Fed chair or the Treasury Secretary that's been in power. Now, at this point, as I say, I think they have less room because the debt is so high, because the stimulus has continued throughout the expansion. Now, as they get into this very difficult recession, and the worst since the 1930s, there's much less flexibility, in there. So it's a very challenging time. And I think, people seem, the status quo seems to have faith in Janet Yellen as a figurehead. She's seen as sort of perpetrating the continuation of policies as they have been rather than any new ideas. And I think in the long run that could be slightly negative because they do, this idea that you can. So in other words, there's been a lot of talk about this monetary, the idea that you can just add debt, continue to run deficits and have no consequences. And I would suggest that we've already had very negative consequences from that policy. And everyone's focused on, well, it's only if interest rates go up that the debt's a problem. Actually, the debt's a problem because we've had such massive malinvestment and we have wasted so much that could have had huge benefit. One of the things that's not discussed, for example, in the whole COVID disaster and the illness and the death and the tragedy, which is just mind-boggling, right? For example, in the United States, they've already lost 400,000 people, which is more than they lost in all of the First, Second World War, the Korean War, the Vietnam War. More people have died from COVID than any of that, right? And that's worldwide, we're over 2 million deaths, and it's the ongoing devastation that's happening. And really, but one of the conversations that isn't being had whatsoever is about the underlying health of people and the food that is destroying our health and how we are ill-prepared for any virus infestation, because we are so vulnerable as a population, because we have more than half the people with massive overweight problems, hypertension, all the illness that goes from eating terrible food. All the restaurants that are closing down, it's a tragedy for small business, but what we really need to talk about is how many restaurants came into being because of the credit bubble in the decade before that, and how many of them are serving food that is absolutely catastrophic to human health, and that's creating all this problem of weakness in our youth and our older people, and how our medical system is overburdened to begin with, because 80% of the people that are using the medical system are there primarily because of lifestyle choices, things they're being fed, and subsidies we're giving to destructive food types as opposed to fresh food. And, so there's huge issues here that we have great opportunity to admit and reform, but only if we talk about more than just, there's this present emergency, and great, once we all get a shot, we can all go back to the way things were. No, we have to actually think outside the box in terms of what kind of businesses we can support and encourage, and what kind of behavior shifts we can support and encourage in the population so that we're not as vulnerable to begin with.
Should Canada have its own vaccine production facilities?
Well, I think that, if we're talking about should we put taxpayer-funded dollars into more asset buying so that corporations can get more cheap debt and do things like financial gimmicks to make their share price go up, versus how about taking some of the money and directing it into things like revitalizing our food supply, revitalizing our ability to generate vaccines and make drugs, for example, in the country that are necessary or helpful to the population. I would say that that's a much more productive long-term investment than financial gimmicks. So absolutely, I think a lot of awareness has come to the fragility of having everything produced in countries with the cheapest possible labor pool, which is basically what we've done through globalization over the last 30 years, is, have all these jobs offshored, have all this production offshored, and take the taxes with it, by the way, because all these corporations have been offshored and producing stuff abroad, and then our tax system has really failed to keep up. So we have had this big drop in revenue, as well as a loss of jobs, and we have filled that gap with debt, both on households and governments. So now I think the revelation has to be that we need a new idea for taxation, which probably goes along the lines of not where a company's head office is, but rather where they sell their product. So in other words, they should pay tax to where they want to market their particular product or service. So if they want, for example, Canadians or Americans to be buying this vaccine as an example, or buying any vaccine, then production in the country where those people live would be a good idea, and paying tax where those sales are being derived would be a good idea, because we have to put money back in the coffers if we hope to have a sustainable economy where the customers and the workers live. We have to really mirror the reality that you can't have the workers in another country being paid there and then expect to just be able to sell everything that you're making domestically when the consumers have now lost the jobs and the government has lost that tax base. We really have to recouple those things.
President Trump wanted low interest rates. Do you think President Biden will continue the push for low interest rates?
Well, again, there's with this level of debt in the world, no one that's indebted wants their rates to go up. But I have to say that we need rates to go up. I don't think they'll go up quickly, but low rates have been this total debt trap that we have now got ourselves into, where people are so indebted that they can barely afford to make payments, even at the lowest interest rates in the history of humanity. So at some point here, the answer is not trying to keep rates lower and lower. At the same time, all these sort of math-based investment decisions are being destroyed in an environment where capital's worth nothing, where savers are getting next to nothing on savings. That is the absolutely wrong environment. You want to have some incentive to people to save and intelligent, rational decisions around investment instead of speculating and gambling and borrowing and throwing it in things and hoping for the best, which is what the population is presently focused on, right? They feel so hopeless. They feel so undersaved. They feel so uncompensated on their savings in any kind of safe vehicle that they feel pushed to do all these really reckless things. Unfortunately, the reckless things end up doing harm and leaving bigger holes than even before. And so it's really it's a race to the bottom. So I do think that they will want interest rates to stay low for as long as possible. I don't think the central banks are going to try and raise interest rates, and they're telling us this. They won't do it for years and years, they promise. But at the same time, it just takes, for example, a repricing of corporate debt. If, we have a record amount of zombie companies today, something like 30% of companies are so indebted and have such an unclear business model. They would have gone bankrupt long ago if they hadn't been in an environment where rates were nothing and people were prepared to throw money at things and hoping they'll win. So again, this price indiscriminate buying of assets, regardless of whether they're a good business or a likely prospect, has really been such a waste. And so we've got all these zombie businesses around, which are interfering with competitive forces. We've got a lot of overgrown giants that are anti-competitive. So there's a bunch of stuff that's happened because of this consolidation and free money mentality. So I think ultimately if corporate debt reprices, then that means yields on that debt will move higher, and companies looking to borrow will have to pay more to access credit, which would be a very healthy thing. That's what we need. We need to see that when you do a calculation, that it makes sense, that money's not free, that there is a return on capital that makes sense.
What do you see ahead for the U.S. dollar?
So as I was mentioning earlier, the U.S. dollar moves in cycles, and I think of it always as a teeter-totter. So you've got a teeter-totter of the U.S. dollar, the benchmark currency, the largest treasury market in the world, which is ultimately what you need to back a currency. And you have on the other end of that the emerging markets, securities, debt, corporate debt, that sort of thing. And whenever you get the U.S. dollar falling, that other stuff rises and vice versa. So I think that having fallen already significantly from, as I say, that the high in March to recent levels, there's quite a bit of support historically around the $89 to $90 range for the U.S. dollar index. And if a lot of the unknowns has now been priced in, and we already know the size of the fiscal package that's been promised, and the central banks have already told us what they're going to do, I think at some point here the U.S. dollar starts to strengthen again. And when that does, that's when the other things on the other end of the benchmark of the teeter-totter will take their next test to the downside. Because again, people talk about, well, there's a lot of, the U.S. is issuing so much debt, and the central bank there is very loose, and that's why the dollar's been falling, which is partly true, but in reality, if you look around the world, every other major economy pretty much is in terrible states and having to issue tons of debt as well to try and get through this worst recession since the 1930s. So to suggest that the U.S. dollar is somehow in a vacuum, or the U.S. economy is the only one that's indebted is a grave error. So it's all relative, and I think that there's no other currency seriously vying for any status against the U.S. dollar at this point or in the next many years. And for that reason, I think we're going to continue to see it in demand. And also there's more debt outstanding in the world in U.S. dollars than any other currency. Those debtors need U.S. dollars to make those payments and to pay that back. And so I think there will always be demand. So I'm just watching for the next leg, really, of recovery in the U.S. dollar. The Canadian dollar is very overpriced at this point, certainly because our economy is that much weaker. We have had some rebound in our jobs, but we lost jobs again in December and January. And our fate right now is pretty sketchy. We have great people, we have great possibility, but we do need to retrain and refocus our economy, shift away from some of the things that we've come to rely on in the past, and look for new business opportunities. new areas for growth.
What do you see ahead for the Canadian dollar?
So as I've just mentioned, that would be a weakening phase, I think, is in line given how overvalued it is relative to where it was even in March. So again, looking for the next repricing cycle there.
Do you follow the cryptocurrencies?
Yeah, so cryptocurrencies would be on the other end of this U.S. dollar teeter-totter that I'm speaking of. It is an intensely speculative asset class. It is not used for anything in particular in the world other than sometimes, kind of underworld transactions, but primarily people profess that it's actually a currency, but in reality they are using it as a what they think of as a asset they hope will go up in price. And of course it has gone up in price as the US dollar's fallen since March, but every time we get into a risk-off phase where everything is in a selling mode, liquidation starts and you see cryptocurrencies crashing as well. So just in the last couple of days they've lost over $100 billion in market cap. Bitcoin itself is down something like 24%. So we keep seeing these abrupt reversals after a huge run-up, abrupt reversal, losing half. That's sort of a common pattern. And the majority of people that are buying it, they profess to be, buying it like as a long-term store of value, but in reality, most of them are buying it as a trade or as a speculation, as a hope that it'll go up. And once it starts to go down, most of them either are forced because they're illiquid and they have debts and they don't manage their risk appropriately. They tend to sell in panic just as they buy in euphoria. So I think it's a highly sketchy asset class, and I think that it'll likely disappoint to the downside a few more times here in the not too distant future.
Gold hit a new high in 2020. Is gold likely to hit newer highs this year?
So when you talk about gold, you have to talk about gold bullion, silver bullion, which is one asset class. That's what you think of as hard assets. And some people have a definite comfort level in holding bullion as something they can store in a safe in their house, and they feel like if the currency markets were to have a major dislocation, at least they have something they could use as a token of currency for a medium of exchange and that sort of thing. So there's that, which I would never argue or just, talk someone out of if they feel that makes them sleep better at night. The question, of course, is how much of their money would they want to have in something like that, which is essentially a bet that everything else is going to go to hell in a handbag. So, if you have a lot of bullion, you're assuming the rest of it is going to have a major down cycle, which, perhaps, but you have to always kind of temper that with what could go right as well, in which case, you don't want to have too much of your funds that are illiquid and not easily transferable. So there's that. And then the other way that people talk about gold and silver is typically through mining companies or ETFs, right? So ETFs is kind of the paper version, and I suggest to you the paper version is a much more volatile enterprise to hold or to try and keep as a long-term hold. It's really a trading vehicle. So you see people will buy it, same with mining companies. They go through these cycles, they get low in valuation, and they can present some good opportunity for investment, but typically people are more inclined to buy them after they've gone up a lot, and then they start to get into the speculative fervor again. So I think you have to always be careful that you're not buying it just because it's gone up lately, because that's a terrible methodology, and you're likely to have a lot of risk of really timing that terribly.
Silver did not get anywhere near a new high in 2020. What do you see ahead for silver in 2021?
Yeah, well, again, people are always referencing the euphoric top of $40 an ounce or something from 2011 when they talk about silver. And at that point, everyone was so confident it was only going to go to 50 soon, and it would be endless upside. Of course, it's a cycle, and it tends to move, as I say, in the inverse of the U.S. dollar. And so whenever that was at the same time that we had the Canadian dollar peak, we had gold and silver peaking in 2011, and then we got exactly the opposite of what everyone hoped in a lengthy mean reversion cycle. So now, again, since March, as the U.S. dollar's fallen, we've seen a huge rally in the price of gold and silver. which people should be happy with. There's been a big gain there if you've been holding it or you purchased it anywhere near the low. Unfortunately, a lot of people, again, don't have an actual methodology. They just buy it because they think it's going up, and then once it starts to mean revert, they sell it again. So it's, where silver's going, it's had a hell of a run up. I think that there's quite a lot of price risk in it again. And if the expectations for the global economy have been overly zealous, which I think they have because of this belief that the vaccine would solve all our problems, I think that, this demand expectation for things like silver, which has legitimate industrial uses, could have overdone to the upside as well here. So basically for all of this stuff, I'm just thinking that we're going to have another sober phase here where people will realize that things have been overpriced, that the problems afoot are longer term and more difficult to solve, that they can be solved, but they're long-term projects. They're not quick fixes. And then at that point, we should see a repricing of all these euphoric pricing, and that will obviously then perhaps present some good opportunity for investment themes.
How much damage have draconian lockdowns and mandatory masking done to the Canadian economy?
Well, I go back to if we were a disciplined people, if the majority of people were, self-disciplined, we wouldn't have to have most of the things that we have. So, for example, if people actually wore their masks effectively, which does have a proven impact on reducing the spread of the viruses, if we were diligent in our use of that, if we were effective in our social distancing and hand washing, which all the safety measures have been recommended from the start of this, then we wouldn't have had to have the amount of lockdown that we've had. Unfortunately, people, even now, 40% of respondents in recent surveys have admitted they don't follow the protocols. So these tend to be people who think that, they shouldn't be told what to do by governments, or that, it's a hoax, or that they don't believe in the math of how this stuff transfers, how this virus actually transfers between people. But again, ultimately, they are then perpetrating the lockdown in themselves, because if we are not following the distancing to prevent this thing from spreading, then you are causing the damage that we are all having to suffer with right now. So instead of trying to blame governments for responding, the question is, if you were a leader in these facts, what would your solution be? And if your suggestion is nothing, well, we tried that in Sweden, and that was a mess. Right? So they tried to just continue business as usual and not have any of these interventions. In countries that took the interventions seriously, where people were self-disciplined, followed the protocols, you had a dramatic drop in spread. The problem here is that we aren't doing it. The spread is escalating. We're seeing the highest numbers we've ever seen. And every time this happens, every week that goes by, this virus has more opportunity to learn and evolve and morph into different systems. And we're seeing that, right, with the UK variant, the Brazil variant, South African variant. So that is even, 56% more infectious than the others, and it's becoming the dominant virus. So we're just having an exponential impact here on spread. So the reality is that nothing is going to be a quick fix for this, not vaccination, certainly, because if the spread is as quickly as it is, and the new variants are that much more rapid, there's no way the vaccination program can get ahead of that, right? So it's one thing to say this is ridiculous, the lockdown, stamp your feet and be angry. The question is, what is your response, or what is your part of the solution? And so if you're not doing distancing, you're not part of the solution. In other words, you're helping to perpetrate the economic harm that's flowing from this. So I think, again, it goes back to being responsible adults and realizing that we all have a role to play in the solution.
The World Health Organization has come out saying the PCR tests used to diagnose COVID-19 is producing too many false positives. If the economy was shut down based on questionable testing, could an economic recovery be just around the corner?
Well, an economic recovery isn't inevitable because we are in the deepest recession since the 1930s. However, it's a question of how quickly we get back into that recovery phase. And although people were euphoric in the summer thinking that, we dodged a bullet and we were back on the upstroke, clearly that wasn't the case. The virus is still very much in charge, calling all the shots, because we are still spreading it literally like wildfire around the world. And so this whole focus on whether the tests are producing too many false positives, so we maybe need better testing. We maybe need more effective testing, but primarily we need social distancing, because if you're distant, you don't even need to have as much testing, right? So primarily we need to keep the distance between people to keep the spread down, so that the vaccination has a chance of getting rolled out and getting ahead of the curve, so to speak. Stop this thing from morphing into more treacherous versions of itself. And then, we can look at getting back to some economic normalcy and growth and recovery of jobs, but that's a multi-year process. That's not going to happen in the next 6 months.
During the COVID pandemic lockdowns, Prime Minister Trudeau has gone on a spending spree. Are we likely to see higher punitive taxes?
Well, punitive, that's an interesting word. Yes, we're likely to see higher taxes. But again, this is primarily about a long-term cycle as well. The top marginal tax rates in North America were 90% in 1940. So if you look back to the 20s to the 40s, right, we had the start of the 1920s. We had a lot of speculative fervor in real estate as well into the 1925. That was a big crash in real estate markets. And then you had this running to Wall Street and bidding up stock prices to before now, it was the worst stock market bubble of all time. Of course, we're even above that now, well above that in terms of the risk factors and valuations that we have. But anyway, in the Depression, when unemployment was 25%, so many businesses failed, revenues were starved across the board, there was a revelation that we had to get more money in the bucket. Otherwise, there was going to be no ability to help stimulate or get things back on track. And so you had the top marginal rates that were 20% in the 20s moved up to 90% by 1940. And in fact, were 80% until 1972, 60% until 1981, and they're 33% today in Canada, as an example. So what I'm talking about is this long-term trend where we were cutting income tax rates for the last 50, 60 years and increasing debt because the spending wasn't stopping, right? That everybody wanted the spending to keep going. The corporate subsidies, the largest corporate welfare in the history of mankind, has happened in the last few decades. And, at the same time, the corporatocracy likes to look at the social programs and say, well, it's the social programs' faults. And the reality is it's everything that was spent and no one wanting to pay for it. So we come into this pandemic and this global depression with insufficient cash in the kitty, with a lot of wasteful spending across the board from all sides of the aisle, and with insufficient tax revenue. And the immature decisions to cut tax, by past administrations, just as they were agreeing to spend more and give out more handouts, they kept cutting tax. So now we've got these big holes in the deficit, all in the budgets, all of most countries. And so, yes, I think that we've ramped up deficit spending and bailouts for companies and corporations, large and small, and households, and we've added to the national debt in an enormous way. So that will have to be paid back, and we're losing a lot of small businesses right now. We know the household hasn't had a pay raise in many years already because of this preoccupation with asset bubbles instead of sustainability. And so absolutely, we're going to have to see higher tax rates across the board for companies and for individuals, very likely. Probably, I've said this before, probably for things like capital gains, dividend income, all this stuff. Because we have to go where the money is. We know where there's IOUs left and right. We have to follow the money to try and actually get investment back on its feet. So yes, I think it's not so much about again, the Trudeau government or the Trump government. It's about these long-term trends that we haven't adequately, shored up the seed corn for the inevitable challenges that come. And every era of human history has a massive challenge. We just got away without a big one for a long time, and so people got lax and sort of presumed that no crisis would ever come. Well, in fact, here we are.
If higher punitive taxes are put in place by the various governments in Canada, are high net worth people likely to move out of Canada? And if they did, where would they go?
Well, exactly. You know, the reality is, I think a lot of people are appreciating that Canada is a remarkably good place to live. We have the rule of law. We have not completely insane politics here. We do have greater adversity between different sectors of our population than we have had in other times. There's been a extreme sort of pushing of left and right apart instead of working to the center. There's been a lot of wealth gaps and underfunding of various serious, important parts of the economy in favor of enriching, for example, asset owners. So what's happened here is that we now have to focus on how do we repair all that damage that's been done, and to maintain our country the way that we enjoy it, with the space and the green space and the distance. Everyone's been moving from big cities, or a lot of people have been moving from big cities to more less populated areas. Canada's got quite a few of those. It's very attractive for many reasons. I know of many people who have been inundated with buying, wanting. Part of the reason we've seen our housing market receive such inflows in the last year is people have a sense that Canada is a safer place. We have a national health care system. All this stuff has to be paid for. So the question is, if you want to avoid tax and go live somewhere, great. Where are you going to go? Be welcome to go to South America, Mexico, wherever you think you can spend less on taxes, but you're going to have to also live there. So, at some point you have to give to get. And I think that adult people understand that you can't have, only handouts and no paying. So I think there's going to be, again, some people, tax avoidance is their primary thing, fine, but they will have to figure out somewhere else to live, and there'll be costs to that as well.
During the pandemic, the Canadian real estate market has been booming. Any thoughts on what's causing the boom and who the buyers are?
Yeah, well, I'm living north of Toronto, where housing prices have increased 25% since March. So I can tell you, we have clients all across Canada. We've been having a lot of meetings, Zoom meetings, in the last month, and basically the same trends are seen everywhere. People leaving the high urban areas, looking for, more green space, distance between homes, out of condos into single families. These are the trends that are happening throughout the country. And the problem there is that we now have, a housing market that is trading in generally across the country at 5 to 12 times median household income. So, for example, nationally, the price of Canadian real estate, we're trading at about 5.5 times the average household income in Canada. But in many of our more populous areas, like in Ontario and British Columbia, for example, that's more like 7 to 10, 12 times the median household income. So we know that there's only we don't have a lot of, there's less immigration, there's less students coming in as a result of the pandemic and the travel restrictions. So you have either it's, wealthy people, the top 0.1% buying another property in the countryside, or there's some of that, but there's a lot of people that have just borrowed more money because rates were low in order to get themselves into another housing area or a second property or whatever. And so condos typically are the thing they're leaving, and we're seeing condo prices weaken in places like Toronto. And they tended to be less expensive properties, right? Condos versus small single-family homes. So again, unfortunately, many people have made this reach for legitimate reasons, I understand why they've wanted to make these moves, but they're doing it by putting themselves deeper into debt. So this is why ultimately it's not a very productive thing, because again, as I've said before, a shelter is a shelter is a shelter. You should have a good shelter by all means, and hopefully you love where you live, but it's not a more efficient shelter if it's a $2 million house versus a $500,000 house. So even in places like Calgary, where property prices haven't actually been going up, and they've been in a sort of a sideways and down cycle since the oil peak in 2015, you still see there that home prices are trading well above 5 times the average household income. So that's still quite expensive. Traditionally, 3 times was always considered sort of affordable or reasonable, sustainable. So that's why if you look at these trends, I think, if we get the pandemic under control a year or so from now, and then businesses look at wanting people to be back in, urban centers more, perhaps not working from home all the time, perhaps partly from home, partly in the office, you could very, very well see a bunch of people wanting to reverse the trend and start going back, and that may be a problem, because if they've bid houses in these lower population areas, properties up by 25 and 30%, so that the average home price is now well over $1 million. There's only going to be so many buyers for those properties, and I think that could be problematic.
Some of my guests have suggested that, yes, people may not want to be locked up in their 500 square foot condo and want more space, but are they really ready for rural living? It's totally different than, living in a big city like Toronto or Vancouver.
Yeah, well, obviously there's rural out in the countryside with no neighbors nearby, and then there's, in neighboring suburbs where you have a bit more lot and single family, but you still have amenities nearby. So, I guess if you go from a condo in a big city with no yard and no maintenance and that sort of thing to a single family dwelling somewhere, you might find that a big shock, and potentially more expensive to maintain, right? Because there is a lot of stuff that goes into maintaining a home. So I think we're also seeing this commingling of generations in different single-family dwellings now, and I suggest that probably won't go away even after the pandemic. I think that's a function of cost and how many people are finding that there's greater efficiencies in sharing the costs of, with parents, grandparents, children. 20-somethings are all moving back home to try and save down payments, this sort of thing. So again, those trends were in play before the pandemic, and I'd suggest that the pandemic's actually made that even more sturdy and durable as a trend, because costs have got that much more impossible.
A survey found 181,000 Canadian small businesses planned to close forever, and surveys found before that over 70% of jobs in Canada and the U.S. are from small business. Is that a serious concern for the economy overall?
Absolutely. And this goes back to the tax base, right? Because individual small businesses in domestic locations are not only provide the bulk of the jobs, but they actually provide the lion's share of the remittances, right, in different payroll taxes and consumption taxes and various things. And if to the extent that they all go away, you have a huge deficit in local communities and in job markets. You also have a huge hole in government revenue from that, and you're left with these monopolies and oligopolies, which we've got. The big box, the Amazons, which as I say, don't pay their fair share of tax at all, and have configured themselves to pay as little as possible, to use labor arbitrage and use the cheapest labor possible, and basically funnel everything up to the mothership of corporate profits, which they've done. But I think that we have to see some pendulum swinging back there. The less small businesses we have, the more we're going to have to, as I say, shift to a new taxation mechanism which collects profits, collects more off of them where their sales are. And it's going to be years to heal this. This is the point. The entrepreneurial spirit of many small businesses, which often cobble together savings from multi-generations as well as debt to try and, get a business going. That the ratios on small businesses are already horrible. Like within, 5 years, 40% of them have failed, and within, a decade, the vast majority are no more. So traditionally, it's a very dangerous or difficult thing to have a small business, but the ones that prevail add an enormous amount of benefit to the communities in which they operate, generally speaking. And so the loss of them this time is going to be a major loss, and it's going to take years to recover and get them back on their feet. So we really do need to focus on how do we engender that after the pandemic, how do we get businesses back up and functioning, and also, what are we subsidizing? Who are we subsidizing? And how do we tax the ones that can afford to pay more of their share, i.e. the larger corporations, which have so far got off pretty easy?
Danielle, how can people find out more about Venable Park?
Oh, we have venablepark.com, which is our firm website. There's lots of information about services and information about what we do, how we do it, how it's different. And then I also write the weekly blog, Juggling Dynamite, where I have articles pretty much posted every day, and as well as interviews and things that people can follow.
Danielle, thank you so much for being on This Week in Money.
Hey, thank you, and good luck to everyone.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Her websites, jugglingdynamite.com and venablepark.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Allan Mark Angell, and Danielle Park, and thank you for listening. If you have any questions for our guests or the show, you can send them to info@housestreet.com. Now stand by for company showcase updates from American Manganese President Larry Reaugh and Golden Arrow Resources Vice President Brian McEwen. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allan. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. My guest is Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Jim, I love being on the show.
You had a news release this week and also some very positive news from the markets.
Oh, yeah, this has been a fantastic week for us. It's a record breaker for us in this office. And our news release was to do with the cathode reactor, and that is all ready now to start production at any time. It had to be wired, and they tell me at Chemecco there were 200 wires. And that had to be in a clean area, and it also had to be rewired from the outside to get it in there. But now it's going, not going. That will be. We've got it prepared to start any time next week. So, and I'm really looking forward to the results on that, because that kind of fills the bill for us with what battery manufacturing requires, and so it's another big plus for us. We've had nothing but plus moves forward, and anybody that follows us on the market, they'll see that stock has closed around $1 today on between the two exchanges, the U.S. and Canada, on about 10 million shares, or better than 10 million shares, maybe 11, and but that's a new high. Last time we were up at 80 cents was when we were doing our manganese project in 2011, and that's just the time the market fell over the cliff. So, no, this is great, and we're getting recognized out there. And if anybody wants to know, I call it the Biden rally, because
He's been talking green for batteries and manufacturing and all those different aspects in recycling that we're involved in. And so, just so happened that the same day as he was elected, or sworn in, the stock took off. And I see a fantastic future for the company from here. People were wondering, who's buying all this paper? Well, the regular group, but also we've been recognized by the Robinhood investors, and they've been putting a lot of buying into the stock, and which is just fantastic for us. That's the new norm out there, and that's stuff that we couldn't reach these states without somebody like that. So I just want to say one thing. I think probably the rally is about 2 years behind, or it should have happened 2 years ago. But then again, when you stop and look at the fact that recycling was really not on the map, now it is. And so you're looking at EV car manufacturing, you're looking at EV battery manufacturing, and now you're looking at recycling of these batteries. And so it's come to the forefront, and we've been always transparent about what we've done and what we're doing. And, I couldn't think of a more solid process than ours. Ours is a great solid process and should, have great dividends for the shareholders at the end of the day. So it's been really exciting in here. You don't get much sleep, but who needs sleep when the stock's going through the roof? So what can I say? I got one naysayer out there. It's the glass is always half empty. Other than that, everybody else seems to be happy. And so, Jim, that's the story. It's probably a little brief. There'll be more news coming next week. We've started work on the Wendon stockpile, and we've got we'll have the start-up date of of our cathode reactor, and so it's and to be very honest with you, I'm as excited about that as I am about the increase in the price of the shares, and our market cap now sitting at about 170 million from 90 million a few days ago. So I think we're in the picture, and I think we're on the radar screen, and that bodes well for the company. To go for our commercial production, it should not be too difficult to raise the money, and but we'll wait till the end of the testing period with the reactor, and then get rolling on that. We have a few ideas that have been run by us, but nothing we're jumping on at the moment, and it's just really great.
Larry, for people new to American Manganese, what's the company all about?
The company is a critical metals company that gets its start in the Manganese project in Arizona, and I can't say too much. I can't say enough about Cometco. Those guys are a group of geniuses. They've done every task that we've asked them to perform, and without them, we wouldn't be where we are today. I mean, as far as I'm concerned, if anybody asked me for a recommendation, I would recommend them and them only. So, to do the research work. And the manganese work they did for us allowed us to compete with China on the cost. Unfortunately, the price dropped below, and but we reactivated the company on Cometco's advice that they thought we could probably do the cathode materials and a lithium-ion battery, and that our recycling process was born. So We've got 3 patents out there. We've got applications out in 11 countries. We've got 4 other patents in 4 other countries. And so, Jim, it's just been fantastic.
Where can people find you on the trading boards, and how can they contact the company?
Okay, first I'd like to say that they can do all the due diligence that is required. If they want to do a deeper dive into the company, they can go to our website, AmericanManganeseInc.com. We're traded on the Toronto Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. And we're traded in Frankfurt under the symbol 2AM. You can contact the company at 778-574-4444, or you can email me at LREAUGH@AMYMN.com.
Larry, thank you so much for the update.
You're very welcome, Jim.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on January 22nd.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Brian McEwen, Vice President of Exploration and Development for Golden Arrow Resources. Welcome back to the show, Brian.
Thank you, Jim. Good to be back.
Brian, Golden Arrow has some new news for us. Can you tell us about it?
Yeah, we're pretty excited to put this news out. It's been kind of a long time coming. We've got one of our main project areas is in Paraguay, and about this time last year we set out our plans for the year, and then COVID hit, and then of course everything went into the ditch, and we've had to negotiate and navigate around all of that. So we've had to take a different approach to what should have been a pretty straightforward exploration program. But long story short, towards the end of the year, or the last quarter, we started drilling holes, and these are not deep holes, they're shallow holes. There can only be a maximum 20 meters because of the type of permit we had. And we've had some follow-up geophysics, and it all came together. And we put out a press release today explaining that. It was well received in the market. We're getting a lot of attention. And I think the most important part about that is that if anybody looking at that press release, it kind of explains the path forward. It shows that what we're looking at is substantial. It could be big. It could be district size. And we're very excited to be moving forward. So like I say, we're very happy to be able to put that out today after that much time and get going forward.
Can you give us a bit of background for the company?
Yeah, the company's been around for 27 years now, I believe it is, 27, 28, mostly focused in Argentina. Joe Grosso is the chairman and president and CEO of the company, and Joe's had great success down there since he lived there for a little bit, and with the relationships he's had, been able to, through the different companies, 4 pretty major, pretty substantial discoveries with the companies. Our last one with GRG was with in a project in the north called Hui that we did with SSR Mining, which we managed to monetize with them, and we put that money to bank, so it's given us money to go forward, sell to a partner, or make some sort of a deal on royalties, and go out and bring the next project forward. I think that's what we do. We do really well.
Brian, where can people get information about the company?
The best information is on our website. I think all of the information actually is at goldenresources.com, or they can phone Sean Perger at the company 604-687-1828 is Sean's number, and he can give any information that people want. People can contact me via the webpage, and happy to always supply information.
Where is Golden Arrow traded?
Golden Arrow is traded on a Toronto TSXV under the ticker GRG. We also trade in Frankfurt, and we also trade in the U.S. on the OTC.
Brian, thank you so much for chatting with us.
Jim, my pleasure. Anytime.
My guest has been Brian McEwen, Vice President of Exploration and Development for Golden Arrow Resources. Our conversation took place on January 19th. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.